Your big bank is ripping you off. Right now, while you're watching this video, they are paying you almost nothing on your savings while they rake in billions from charging high interest rates on loans and credit cards. You are literally leaving thousands of guaranteed dollars on the table. Money that should be in your pocket earning interest for you is instead making your bank CEO richer. Today, we are settling the ultimate financial showdown once and for all. High-yield savings accounts versus certificates of deposit. HYSA versus CD. Which one is your personal money printing machine, and which one could be a hidden trap that locks up your cash when you need it most? I'm going to give you the exact criteria to pick the winner for your life, your goals, and your money. Let's earn. Before we dive into the battle between these two powerful savings tools, we need to understand the playing field. Why are we even talking about high rates right now? The answer is the Federal Reserve. The Fed controls the baseline interest rates in our economy, and over the past few years, they have raised rates aggressively to fight inflation. When the Fed raises rates, banks can offer higher annual percentage yields, or APY, on savings products. That's why you're seeing rates of 4, 5, even over 5% on some accounts right now. These are the highest rates we've seen in over 15 years. But here's what most people don't understand. High-yield savings accounts and CDs are not wealth-building tools. They're not going to make you rich. They are defense tools. Their job is to protect your purchasing power from inflation. Think of it this way. If inflation is running at 3% per year, and your money is sitting in a regular checking account earning 0%, you are losing 3% of your purchasing power every single year. Your money is worth less and less. A high-yield savings account, or CD, earning 5% is your shield against that erosion. You're not just keeping up with inflation, you're actually staying ahead of it, and that's the whole point. Now let's talk about high-yield savings accounts. What exactly is HYSA? It's a savings account, usually offered by online banks, that pays significantly higher interest than traditional brick-and-mortar banks. We're talking 4 to 5% APY versus the 0.01% you might get at a big bank branch. Why can online banks offer these rates? Because they have lower overhead costs. No expensive buildings on every corner, no armies of tellers. They pass those savings directly to you in the form of higher interest rates. Now, I know what you're thinking. Is my money safe in an online bank? This is the biggest fear people have, and I want to address it head-on right now. If the online bank is FDIC insured, your money is just as safe as it would be at the biggest bank in America. The Federal Deposit Insurance Corporation guarantees your deposits up to $250,000 per depositor, per bank, per account category. This means if the bank goes completely under, fails overnight, the federal government will give you your money back, up to that limit. This is not some sketchy insurance. This is backed by the full faith and credit of the United States government. The same protection covers your local branch bank and your online bank equally. But here's the critical thing you need to understand about high-yield savings accounts. The rate is variable. Variable means it can change at any time. Today, your account might pay 5%. Tomorrow, the bank could drop it to 4%. Next month, 3%. You have zero guarantees. The bank is not locked into paying you that rate. If the Federal Reserve cuts interest rates, banks will lower their savings account rates almost immediately. This is the single biggest risk of HYSA. You cannot count on that rate being there 6 months from now or a year from now. That said, high-yield savings accounts have one massive advantage: liquidity. You can access your money whenever you want. Need cash for an emergency car repair? Transfer it out. Found a better rate at another bank? Move your money today. There are no penalties, no fees for withdrawals. Most HYSAs let you make up to 6 withdrawals per month, which is more than enough for most people. This flexibility is incredibly valuable, especially when life throws you a curveball. Now let's switch gears and talk about certificates of deposit. A CD is fundamentally different from a high-yield savings account. When you open a CD, you are entering into a contract with the bank. You agree to lock up a specific amount of money for a specific period of time, called the term. Common terms are 6 months, 1 year, 3 years, 5 years. In exchange for locking up your money, the bank guarantees you a fixed interest rate for that entire term. This is a contractual promise. If you open a 1-year CD today at 5% APY, you are guaranteed to earn 5% for the full 12 months, no matter what happens to interest rates in the economy. This guarantee is the superpower of CDs. Let's say you open a 2-year CD at 5% today. 6 months from now, the Fed starts cutting rates, and high-yield savings accounts drop to 3%. Your CD is still earning 5%. You locked in that rate. This predictability is incredibly valuable if you have a specific financial goal with a specific timeline. Maybe you're saving for a down payment on a house in 2 years. Maybe you have a big vacation planned in 18 months. A CD lets you know exactly how much money you'll have at the end of that term. No surprises. no variables. But CDs come with a massive red flag, and you need to understand this before you put a single dollar into one. Early withdrawal penalties. If you need to access your money before the CD matures, before the term ends, you will pay a penalty. These penalties are not small. For a 1-year CD, the typical penalty is 3 to 6 months of interest. For a 5-year CD, it could be 12 months of interest or more. Let me give you a concrete example so you understand the pain here. Let's say you put $10,000 into a 1-year CD earning 5%. That's $500 in interest over the year. But 6 months in, you have a medical emergency and you need that money. You break the CD early. The bank charges you a 6-month interest penalty. That's $250. Not only do you lose the interest you were supposed to earn, you actually lose money you already earned. You might even dip into your principal depending on how the penalty is calculated. This is a real cost, and it's why you should never put money into a CD unless you are absolutely certain you won't need it before the term ends. So now that we understand both products, let's put them head to head and see which one wins in different scenarios. Rate risk. High-yield savings accounts lose here. Rates can drop tomorrow. CDs win because your rate is locked in. Liquidity. High-yield savings accounts win by a landslide. Access your money anytime. CDs lose because your money is locked up. Predictability. CDs win. You know exactly what you'll earn. High-yield savings accounts lose because the rate can change. Here's how to think about this in terms of your actual financial goals. High-yield savings accounts are perfect for your emergency fund. This is money you might need at any moment. A job loss, a medical bill, a broken furnace in the middle of winter. You cannot afford to have this money locked up in a CD with early withdrawal penalties. Put your emergency fund in a HYSA. Aim for 3 to 6 months of living expenses. That money sits there, earns a solid rate, and is ready when life happens. CDs are perfect for fixed-date financial goals. You know you need $5,000 in exactly 18 months for a wedding. You know you want $10,000 in 2 years for a down payment. You know you're taking a big trip in 3 years. These are perfect CD scenarios. You lock in the rate, you know exactly what you'll have, and you're not tempted to touch the money because the penalty keeps your hands off it. It's almost like a forced savings mechanism with a guaranteed return. Here's a pro strategy. Use both. Keep your emergency fund in a high-yield savings account for instant access. Then take any extra savings beyond your emergency fund and ladder CDs. CD laddering means you open multiple CDs with different maturity dates. Maybe one CD matures in 6 months, another in 1 year, another in 18 months. This way, you're always locking in rates, but you also have regular access to chunks of money as each CD matures. You get the best of both worlds. Let me give you the Aaron Invests 3-step action plan to put this into practice today. Step 1. Calculate your emergency fund. Take your monthly expenses, multiply by 3 to 6, and that's your target. If you spend $3,000 a month, your emergency fund should be $9,000 to $18,000. Step 2. Choose your account. If you don't have your full emergency fund yet, open a high-yield savings account and start building it. If your emergency fund is already solid and you have extra savings with a specific goal and timeline, open a CD. Step 3. Open the account today. Not tomorrow. Not next week. Today. Go to a comparison site, find the highest-rated FDIC-insured bank offering the best rate, and open the account. It takes 10 minutes. The difference between someone who takes action and someone who just watches videos is execution. You now have all the information you need. You know the difference between HYSA and CD. You know the risks. You know the benefits. You know which one fits your goals. The only question left is, are you going to do something about it? I want to hear from you. What is the one thing you are saving for in 2026? Is it an emergency fund? A down payment? A vacation? A new car? Drop your goal in the comments below. Let's hold each other accountable. If this video helped you understand the difference between high-yield savings accounts and CDs, smash that like button and subscribe so you don't miss the next one. I'll see you in the next video.